Good morning. Welcome to Hubert to Taxes Made Easy here with Guardian Tax Law. Just want to cover some information real quick. Sorry I missed the intro today. Just lost track of time. It's been a little bit of a crazy morning. But today we're going to focus on a couple, really dealing with the largest state that has the most tax issues, the California. So California in particular, the California Franchise Tax Board. Again, there's a lot to dive into there. There's a lot of issues, and it's different than the IRS. So we're going to kind of do a deep dive into California. And before we go there, I want to talk about, again, some of the things that's happening in the news. So some of the biggest things going on in the news is we've got the new registration or the IRS is pulling out these new filing systems where you can do free file. We talked about that in 7 different states, and a new reason to do that is for 2020 and then next year 2021. You only have 3 years to get a rebate. So, and that's 3 years from when the tax return was supposed to be filed. So if, again, the IRS goes back 6 years, but again, if you have a refund in a year and you file more than 3 years late, that's your loss. So it's money that you paid in or credits you have available to you. And if you snooze on your rights, if you don't claim them, you lose them. So that's another problem with filing late returns or amending returns and waiting too long. If you wait too long, you lose your rights. And so it's a very frustrating thing. So one thing that Congress did through COVID in 2020 and 2022, they gave a credit. So in particular, it's the recovery rebate credit. And I believe the first one was $1,600 and the next one was $1,000. But again, for 2020, this is free money. This is money the government just said, hey, we're just going to give everybody a little bit of money to try to help through COVID with their tax return. It didn't matter if you owed or not, the money is supposed to be paid directly to you. So if you do owe, you're still supposed to get this credit, but you have to file a tax return to get it. So if it's kind of a no-brainer, if you haven't filed, to go ahead and file. The deadline to file and still get the credit is May 17th of this year. So the reason for that is for your 2020 return, you would have filed that by April 15th of 21. And they extended that deadline out because of COVID out to May 17th. So we're coming up on 3 years since when your 2020 tax return was due. So May 17th, 2021 was the filing deadline for that year. So May 17th of 2024 is exactly 3 years later. So what happens if you wait and you don't file on time? You just don't get the credit. You don't get any refunds and you don't get the credit. So if you owe $5,000, the IRS will still pay you the credit. And you might have to file that tax return anyway, especially if you want to deal with your taxes head on. So, as far as the 2021, you have another year to file that and get the credit. But again, if you wait, you lose your rights. And that's a general principle law, that if you wait and you sit on your rights, you lose your rights. So pretty much anybody that's a U.S. citizen or resident and you haven't been claimed as a dependent can get that credit. There are free online systems. There's VITA centers where you can go and get that help. And again, the IRS tacked on a little note there that they are going after high income tax returns. So from 2018 forward, they're going to be sending out, again, 125,000 letters. Another reminder that if you're again, they're going to be going after all kinds of people. If you haven't filed those returns, they're going to be sending letters out there and starting to collect on you. And so, again, if you don't procrastinate when you should be getting that done, go ahead and move on it. As far as today, California Out of all the states, their collections department is probably the most organized. And because it's the biggest, New York is a close second. It is very different from dealing with the IRS in quite a few ways, but it is easier to maneuver through in most ways. So there's the main franchise tax board line, and I'm going to give you that. It's 1-800-689-4776. Now, are there times where you can't get through? The lines are too busy? Absolutely. But most debt with California it's usually about a quarter to a third of what the IRS debt is. So but if you have a balance over 25,000, there's a better number to call, and that's 866-418-3702. For business collections, it's 916-845-7033. And then they have other lines that go through this. So the nice thing about when you call into the franchise tax board, again, there's times they're too busy, their phones are clogged, and they'll just say call back another day. But they're not like that. It's a lot easier to get through the franchise tax board than the IRS. However, their hours of operation are usually from 7:30 to around 4:30. Technically, they're open till 5, but they're wrapping up calls, they're wrapping up things. So if you call after 4:30, you're probably not going to get through. And that's Pacific time. All the times are Pacific time because we're talking about California. Now, the frustrating thing with California is a lot of people have left California or are leaving California. So you have people that owe California all across the country and that are still dealing with the California Franchise Tax Board. So when you call in, have your social security number ready, and it will route you to the appropriate department most of the time. So again, it's much more helpful when it gets to that point, and it is very similar to the IRS in that the very first things they're going to look for are compliance. So that's payment compliance, filing compliance. And that's going to be with anywhere. Any state is going to have the same compliance requirements. So it's not as strict as 6 years with the Franchise Tax Board. So let me, it's interesting. As far as how far back do you have to go with the Franchise Tax Board, ask them. They might not have you go back 6 years. You might have older years that are much older that they're going to require that you file. And one thing about the Franchise Tax Board, if they filed for you, and they call it a filing enforcement, so they went and they filed the tax return for you, they want you to file an original return. Now, if you just pay that off, okay, they'll leave it alone because you paid it off. But in most cases, they want you to file original returns. And these returns can go back much further than the IRS. So how far back can you get the information that's required by the Franchise Tax Board? And I've seen it sometimes they're going back 13 years or more. Well, first place to look is your own records. Second place is the IRS. The IRS does keep wage and income transcripts 10 years. 10 years back. So right now they're going all the way back to 2014. Oh no, yeah, 2014. We're in 24, they keep all the way back to 2014. Now, if you have older returns that need to be filed, where can you get that information? The California usually has some kind of basis for their return. If they just made up the numbers, which Californians want to do, or they often do, you can find out where they got their information. And if they just made up numbers, you can make your numbers up right back, making educated guesses. But even better, you can go to the Social Security Administration and get the income that was reported to them. If you know you weren't working in particular years because you were unemployed, you were sick, you were incarcerated, whatever happened, you went through a divorce, your income was down, you can do that. California is known for, they will assume you had certain amounts of income. So again, I've had people that were imprisoned, and California assumed that they were doing this kind of job before, or they had a contractor's license or a realtor's license, and they assumed that they were making that amount of money and taxed them accordingly. It's pretty brutal. But once you file your original returns, you can replace those. In California, knowing their numbers are made up, they're pretty willing to work with you on those numbers. So as long as you have some basis to file your return and claim in a lower amount, usually often much lower amount. California, they'll be very aggressive in collecting, but once you're in communication with them and you're working on the returns, they'll usually take a step back and say, okay, we know we made up these numbers, but get your actual returns in and we'll work with you. It's kind of funny that, while they know they made up their numbers, they'll be very aggressive, and usually because people have moved out of the state or they moved around, they'll go after bank levies. They'll hit they'll garnish your wages. Doesn't matter where you are in the country, they'll still hit your bank accounts and garnish your wages, and they'll put it on you to respond and get that information to them. But once you do, again, they'll lower that balance. So if you're leaving California, how do you stop that? How do you make sure California doesn't come in and stick it to you when you're not looking, when you don't even think you need a file? It's important to file a final return, and this is not just California. So to be a little extra cautious, so a lot of times people don't leave on December 31st. They leave throughout the year. So you want to file a final return that's a non-resident return. So that means you're filing with California and saying, California, I'm now a non-resident. I have now moved to this other state, so I'm only filing a part of your return. I'm gone. We have a hard break. I'm coming back right after this commercial break and continue the conversation. Hubert Johnson here with Guardian Tax Law. Thank you for watching today's episode. It's all about the California Franchise Tax Board. So one of the important things here is that you're getting your tax returns filed, you're getting the information in, but file that final return to make sure that California can't come and surprise you with their own filing enforcement saying, hey, we don't know you left the state. Let them know you left the state. Let them know you're done. Let them know and wrap up that responsibility so you don't have that moving forward. So go ahead and close that off by filing a non-resident return so they can't do that. Now, getting a representative of California is a little tricky. They do have a power of attorney. It takes them a while to process the power of attorney. And so it's much harder to get through and actually communicate with them. Now, if you do have an issue with them, it's important that you go ahead and if you need representation, get it. But it's key that you keep their letters. So if one, the letters will tell any professional what's going on. They can read them and interpret them very easily. And I say interpret because they're not always easy to understand what's going on, what the letters mean. And that goes for the IRS as well. But you can have someone call in with those letters, with the information that's on the letters, and start representation right away, rather than waiting for a power of attorney to process. If you have a bank levy or a wage garnishment going on, it's important to get that case started right away. So hold on to those letters. Don't just throw them away. Don't just burn them. They actually mean something, and they're important. If you're getting those letters, you might want to call someone and get some help. Make sure you're protected. So once you call and you get your tax returns filed, during this time period, you want to get a hold on collections like you normally do. But the California they have a financial form. Every state pretty much has some kind of financial form to go over what you can afford to pay. Pardon me. So California's is a little different, and their power of attorney form is called a 3520. Their financial form is called the 3561. So we're going to do a little screen share and make sure. There we go. This is the California form 3520 or 3561. Now, interestingly enough, we're using our handy friend, Mr. Test T-Test. And this gives us a good look of what's on the financial statement. So let's go ahead and make this a little bigger, because some of us are old, like myself. So the first part of this, it's pretty basic. Social security number, driver's license number, home phone, cell phone. You start off with your name. Dependents, employment information. Again, very similar to the IRS 433A. This is where they get into assets, Section A. So financial institution, credit cards. Now, the IRS typically doesn't want to know, or they don't care too much about credit cards. California does. Now, are they going to give you credit for the credit card payments? No. But they want to know if you have a lot of credit balance where you could just pay them off with credit cards. They don't care that you have to deal with the credit cards later, but there are times it makes sense to just pay California off and get them off your back. Real estate, again, very similar to how the IRS operates. They'll give you an 80% valuation of real estate. Cars, boats, recreational vehicles. Again, the IRS and the franchise tax board, they do not want to come seize your property. Again, it's a huge pain. But you don't have enough room for all these assets, but you want to do an attachment and list all this out. So cars, boats, recreational vehicles, life insurance, artwork and jewelry. If you have things where individual items are worth $10,000 to $20,000, then list them. Otherwise, if you don't have anything that's that valuable, most people don't, just don't list it. Monthly income. Now this is a big difference here. They want net pay. So they don't look at your gross pay. They want your net. Makes it a little bit easier to calculate. What the IRS does is they do the gross pay and then they subtract everything out. That's allowable. But if they want your net pay or what your take home is. And then from your spouse, they want net pay as well. Then net rental income, again, this is your income section. All your sources of income, they want to know all sources here. Even if it's taxable or not. Well, I was working with someone yesterday that had VA disability. While it's not taxable and it's not reported on the tax return, they're looking at total monthly household income. And it does need to be included on these financial forms. Now we get into the expenses, and this is where it can be very similar, or you can get more. So for housing utilities, you can take the IRS standard and just list that out. And just say, here's the standard. Or you can get well above the standard. And this is one reason, because the IRS standards are so ridiculously low, especially for rent and mortgage. You can get well above the IRS standards when negotiating with the states. They usually go off the actual allowables. If it's crazy high, if it's too crazy high, you're living in a poor area and you have a crazy expensive home, they'll probably question it. But you can get your actual numbers here, which is a huge difference and a huge benefit compared to the IRS. If you want to just use the IRS standard, just mark the box. Ownership costs, mark now you have to prove these up. So ownership is how much it costs you to own a vehicle. So the car, mortgage, or the lease. Again, if you're just going by the IRS standard, click that and put that in there. But operating costs for gas expenses, you can just click that, put in there. But if you're spending more than that, you just want to make sure it's showing on your bank statements. If you tend to pay cash, use your debit card. If you use a credit card and pay it off every month, that's fine too. And you can go through it that way. Public transportation. If you're using public transportation too, very common in California in certain areas, you can get credit for what you're spending on that as well. If you just want to make it easy, just check the box and you can use the IRS standard as well. National standards, again, you can use the IRS box. If you're spending more though, you can get it with the states. So these are exactly the same categories for food, housekeeping supplies, clothing, personal care products, and miscellaneous that the IRS uses. You can either just list out what the IRS has or just check the box, or if you're spending more, put that and have some kind of explanation. Just be ready to have an explanation for that. If you're spending $500 more, I have this allergy, or I'm a trucker, I'm on the road all the time, this is what I need to actually spend. And most of these are very close and mirror what's on the 433A. It's just you're using net, and you can get above the allowables, the IRS allowables. The IRS is pretty strict. Once you hit those allowables, in most cases, that's it. There's a few exceptions to that rule, but they've made that very strict over the last couple of years. Out-of-pocket health care, again, you'll get what you're actually spending, or you can just go with the IRS standard. Child dependent care, which is care for your children while you're out working. So if you have them in daycare, if you have them in a preschool program, something while you are out working. Now, if you're a stay-at-home mom and you just want a break, there's nothing wrong with that, but it's not seen as a necessity, so that they will not give you credit for it. If you are dealing with a child that is autistic, if you're dealing with a child that has special needs and needs to be it should be in a special program, you'll get credit for that, because that's more of a health care issue, and also you could argue that it's a personal care issue for the provider. So again, it depends on how you frame it. But if you have a family member, excuse me, I've done this plenty of times where someone's paying a family member to help watch the child, and they're paying the family member but in cash. So we'll start writing a check, put in the memo line, do a Zelle transfer, and mark the reason, daycare. For these, if they're providing daycare through the day, you can pay them, track it so you can show how much it is, and then you'll get credit for it. So I just want to make sure I'm not going over on my time. We're fine. So as far as most of these other costs, term life insurance, retirement, they actually give you credit for that, for those payments. Federal installment agreement, student loans, court-ordered child support, alimony, health insurance, and then other necessary expenses. You just have to put them as necessary. They're not going to count on secured debt. Personal loans and credit card payments are the biggest ones. And then you just look at your monthly income, not the expenses, and the difference there. So it's pretty straightforward. Biggest differences are there aren't caps on allowable amounts, and you're using the net income. So, and then if you have a business, small business, you can fill out this information as well, and then that's the end of the form. Pretty straightforward. If you have questions about that, give us a call. But here's the key thing to know. With the Franchise Tax Board, and in all states, if you owe state taxes as well, state and federal, remember these tax debts don't go away for 20 years. They continue to accrue interest and penalties, so you're most likely going to end up paying this. So if you qualify for a hardship status and you just can't afford to pay it at a time, you're well within your rights. California has a pretty decent hardship plan. New York has a great offer and compromise plan. California has a horrible one. New York doesn't have a hardship plan or program. California does. So, but they'll put you in a hardship status for up to 12 months at a time, which means you've got to be ready to address this again in another 12 months. Once you get into it, if your situation hasn't changed, you can it's much easier to get you back into the status, but they will review it every year. And again, so that's for 20 years if it's a recent debt. If your debt is much older, it might only be a few years of doing that until the debt falls off. Now, California's really nasty about sometimes they'll increase that 20 years. It depends on when their tax returns were filed. So again, if you file your state tax returns much later, that 20 years doesn't start until the tax returns are filed. So again, it's get those tax returns filed, get ahead of it, and it can save you a lot of heartache down the road. So as far as the installment agreement, you can do a partial pay installment agreement where you go in and say, look, I can only afford $100 a month. And if that's what your financials show, and it's proven up by your bank statements, because California will always ask for bank statements. They want the 3561 in your bank statements. And they see if everything's flowing through your bank statements, it's not a big deal. You should be fine. If it's not flowing through your bank statements, then they'll question it. But once you get those two things in, you can get a bank levy released, you can get a wage garnishment either reduced or released based on your ability to pay. And California is pretty quick to get that released. Once you do that, they have a levy line, and they even have most of the fax numbers for the big banks. So a lot of times they don't even need you to get the fax number to send the release to. Now, I just want to touch on some other forms because California is not that simple. So they have the Board of Equalization. That's another separate department from the Franchise Tax Board. The DTFA, which is a new organization over at the IRS, relatively new. You have the EDD, which deals with unemployment insurance and labor issues. But with it, you have the 3520BE. So this is a power of attorney for businesses. And then so you have the installment agreement form, which is the 3561. And then you have your offer and compromise documents, the 4905. And the PIT is the one, the power of attorney that you want to be filing. And that's what we always use. So getting back to working with them, I'm going to go and stop sharing. The key to working with the Franchise Tax Board is communication and staying on top of them. If you let things lapse, they will hit you, and they will hit you hard when you're not looking. California is known for being very aggressive, and so they will. If you don't get your returns done, if you wait too long, they will come after you. And so again, this is don't play around with them. And in general, I was talking about overall strategy. If you owe the Franchise Tax Board and the IRS, I would much rather you pay the state. Again, they have similar penalties and interest, but the state, the tax debt doesn't go away for 20 years. It's much harder to deal with in general. And if you set up an installment agreement with the state, that will lower how much you have to pay to the IRS. So it can help you and be beneficial in multiple ways to go ahead and just deal with the state, take care of them. They're pretty good about installment agreements, and they're pretty straightforward. They prefer to do direct debit installment agreements with the California Franchise Tax Board. That way, they know they can just take the money and continue on it. If you are on a direct debit installment agreement, when the money is paid, make sure they stop taking the money, because the states are not, California's known for continuing to take payments. They'll refund it to you once you call them out on it, but you have to call them out on it and say, hey, it's over, stop taking the payment. I think they've gotten better over the years, but in the past they've had a problem with that. And we're coming up on another break in a couple minutes, but I want to talk about some of their business issues that you have to deal with, and also their offer and compromise program. So California does have an offer and compromise program. It's horrible. So that's why if you can qualify for an offer in compromise or a lower payment plan or something, a better deal with the IRS, it makes a lot more sense to settle with the IRS, get rid of that tax debt, and then slowly pay off the state. If you can't afford to pay either, we do that. And there's times where, in other states, we've done an offer in compromise for the IRS and the state. California's offer in compromise, you have to be fully retired and of retirement age and or fully disabled with no expectation of going back to work. Those are the two criteria that you have to meet. So if you're younger and you incur tax debt, California's like, we have plenty of time to collect on you. Why would we settle? They don't care. It's all about, can they collect eventually on the tax debt? And if they feel like they can, they're not going to settle. They're not going to do an offer in compromise. So with and we're running out of time, so I might have to really do a deep dive into this when we come back. But that's their general principle. You have to be fully retired or have no expectation of being able to work and bring in income. So essentially they're looking at people on disability or Social Security on a fixed income, and those are really the only people that qualify for an offer with the California Franchise Tax Board. Again, we're coming up on a break, and we'll be back in just a couple minutes. But again, if you have any questions, give us a call at 520-485-7371. Welcome back, everybody. Thank you for watching Taxes Made Easy here with Hubert Johnson from Guardian Tax Law. I want to touch on one thing before I continue to dive into their offer and compromise program. When you have a case, and if it's a large enough case, they'll send you to special compliance or their account collections units, special collections units. And if you have an individual assigned to your case, that's good news. It means it's going to be a lot easier for you to get through and talk to somebody. You can email them, you can fax them. And the IRS won't use email. The states often will. California will. So what do you do if you get someone's number, someone's assigned to your case, and they're not responding? Call the main line. Get directed to their group number. Tell them, hey, I have someone assigned, but they're not responding. Can you send me to their group? And they'll send you to their group. Someone else should pick up from their group and say, oh, well, so-and-so is on your case. And you just tell them, look, I've called, I've emailed, I know they're busy, but it's been 4, 5, 6 days, or I have an urgent issue and it's been a couple days and they haven't got back to me. So they'll do a couple things. They'll either try to help you on the spot, or they'll assign someone else to your case, and someone that can pick up and work the case right then and there. Don't use and abuse this, but if you can't get a hold of your representative, you can always call the main line, and they can either get someone to call you right back, the person that's assigned your case to call you right back, or if they're not responding, they can help you out or have someone else in the department take over your case and help you out. And sometimes they'll help you out with just that call, and then they'll have the person assigned to your case follow up with you. They are very busy over there, but it's a great way to get some feedback and to actually get in touch with the person that's handling your case. And that's usually the same person when somebody picks it up. So once you get their phone number, if you're a little further into the collections unit there at the Franchise Tax Board, you can deal with the same person, which is very nice. With collections, you can't deal with the same person unless you have a revenue officer assigned. So it's much tougher to get things done. Every time you call and you're talking to someone different, and they could often ask for different things. So that is handy with the Franchise Tax Board. Just make sure that you're working with them, that you're getting things done. As far as the offer goes, when you file an offer and compromise with the Franchise Tax Board, it doesn't necessarily stop collections. They can and often do continue to issue wage levies, bank wage garnishments, bank levies, etc., as they go after a taxpayer. So be very mindful that that does not protect you. So I highly recommend getting into a hardship status or some kind of low payment plan and then filing an offer in compromise. Now, again, you just use the financial form. They have a different form to determine what your offer is with the Franchise Tax Board. But really what they're looking for is the original assessed balance of the taxes. Can you get lower than that? Yes, but it pretty much has to be every dime you have. So any asset value, anything less than that, and the poorer you are, the more likely they are to take something. But they want their pound of flesh. New York is the same way. They want a chunk of change. And what the Franchise Tax Board is looking for. So let's say if you file 10 years ago and you owe 20,000 and now the debt is up to 60, 70,000. They will accept an offer for the 20,000. If you show you're broke as a joke, you don't have any funds, there's no way for you to get the funds, and you only have 10,000 in assets. If you take that 10,000 and give it to them, it's possible they'll take that offer and then settle the balance. But again, it's very hard to do because once they don't give you time, that's the hardest part. New York's offers are much easier, much better. They'll give you time to make the payments up to 5 years to pay off an offer amount, which is very handy. California gives you 30 days. So you submit the offer, you wait on them, and then boom, they want you to pay the balance. If they accept the offer, they want to pay it in 30 days. So you have to have that put in place, either something ready to sell, or you have to, or if you sell it and you just have the cash, here we go, have that ready to give to the Franchise Tax Board, or you have a relative standing by. I had one case. I was a retired post office worker living in San Francisco. He did not get enough from his pension to make ends meet. He was struggling mightily, and we got an offer accepted for him, and he was relying on a relative to pay the balance. The relative backed out, and his offer fell apart. So again, very frustrating for him. And we ended up just putting him in a non-collectible status or a hardship status for multiple years and took care of him that way. But again, it's very hard to wipe out franchise tax board debt. Now, it has to be older debt. They don't want to do an offer on brand new debt because they're like, we still have 20 years to collect. Let's see what happens. So they want the debt to at least be 4 to 5 years old. The older, the better. And again, if those interest and penalties accrued, that's going to be the number one thing that you're settling with an offer and compromise. But don't bank on being able to do an offer and compromise with California. They will scrutinize it. They will look at it. They will poke it around, and it's not. They don't tend to follow rules like the IRS. The IRS doesn't always follow their rules, but you can call them out, and you can usually hold their feet to the fire and say, "Hey, these are my client's rights. You need to follow and respect these." California likes to make things up as they go, so they'll make up different reasons why the offer shouldn't be accepted. They do have a taxpayer advocate system. It's not very robust, and if you're in the middle of an offer, they might not be able to help at all. You always can appeal. California's try to improve on this, make it so you can appeal to a manager. You do have appeal rights, like a cap appeal with or CDP request with the IRS. But again, that's limited. It's not nearly as well organized as the IRS appeals. So going through an offer, never plan to do an offer with the Franchise Tax Board. You do it, but prepare for the worst, plan for the worst, and then if they do accept an offer, remember don't submit an offer in futility. Don't waste your time. Don't waste your money. You can always try it just to see, but don't pay someone a ton of money to do something that's likely going to fail. And again, I've shared some experience I've had where people said they just submitted them and they got rejected, and they're like, "Oh, well, I tried." But you charged and hurt your client on the way through this. So that's not, in my opinion, it's not a good way to do business. That's not a good way to take care of your clients. Business issues. So this is something where a lot of people get in trouble with the Franchise Tax Board. And they've gotten a little better about this over the years, but if you create any business with the Franchise Tax Board, you need to file with the Secretary of State, and there's an $800 a year fee for your business license that you have to file and pay regularly every single year. So what they've done in the past is if you close out a business and you don't close it out with the Franchise Tax Board, they will still require you to get current and file all those missing returns and pay all those fees before they'll close out your business. So if you haven't filed for 5 years, you've got to file your returns, pay the $800 for every year, plus any additional penalties and interest. And if it goes into year 6, guess what? Now you got to file again for year 6, pay all those fees, and then they'll close out your business. It was very difficult to deal with. A lot of people were getting snowed under by fees. And so California did make an adjustment. They do have some voluntary dissolution programs now where you can avoid filing some of those older returns. They usually want you to file a couple and close it out. And it's a specific program. You have to meet some criteria to qualify for it. But that's a huge step forward in that they will do a voluntary dissolution for you and avoid a lot of the problems and headaches that a lot of people had closing out businesses in California. So if you don't pay this and you fall behind, your business would be marked as inactive, but not closed out, and you would still have those ongoing filing requirements. So it doesn't matter what state you're in. When you close a business out, make sure you close it out with the Secretary of State, and the way to do that is different by every state. So check with your state, make sure you get those closed out correctly. When things are falling apart, people don't think about closing things out correctly with the IRS. And the state IRS is pretty easy, but the states are much harder when closing those out. So another big issue with the California is sales tax. Now that's not the California Franchise Tax Board. That's that new organization that they came up with. And sales tax is a really big issue. If you end up owing sales tax, California is very aggressive about it. And there's plenty of other things that the Franchise Tax Board will collect on. So people get notices. The Franchise Tax Board is collecting, and it could be for child support, or it could be for a debt to another agency. Sometimes it's court debt that's farmed out to the Franchise Tax Board to collect on it. So how do you know who to even talk to? So if you call the main tax unit, they can't see anything. There's a non-tax unit that you can call. And so the non-tax unit is 916-845-4064. And so that's another unit to call and see what's going on. Is there other tax debt out there? If you're not sure where this tax debt is coming from, it could be one of the, just any kind of debt to the state of California that's been farmed out to a portion of the Franchise Tax Board, but that's not a tax unit. You do have many of the same rights to set up an installment agreement. They don't really do offers with non-tax debt. But again, there are a lot of different organizations. There's, the BOE, the EDD, I think it's ACTA, the FTB, and then you even have non-tax debt with that. So if you're lost and confused and you don't know who to talk to, which happens a lot, try these different organizations, try to find out where your debt is. The letters that you get are very important because they can tell you which organization is collecting, where is this tax debt coming from. It's harder when you don't know where the tax debt is coming from. If you get a bank levy, if you can get the levy notice, that might give you some information. But sometimes you're just calling and trying to figure out, okay, who's hitting me? How do I fix this? And so knowing which organizations there are and how to call and reach out to them is very important. Whenever you're hit by a bank levy, you only have 10 days to release it with the Franchise Tax Board. So that's 10 business days. So that's 2 weeks, and then the money's gone. So it's very hard to get money back once it's actually sent to the Franchise Tax Board. They're pretty good about releasing it. They're going to want to, financial information. Sometimes they'll just take it over the phone, or they'll want a 3561 signed with bank statements. But you can usually get that put together pretty quickly as long as you have decent information. Now, if you have business debt, again, you have to present your business information. It's going to be the same as other financials: profit and loss, balance sheet, and asset list. And they might ask for accounts receivables as well. But again, they're collectors. They're looking for easy money. They're not looking to scrutinize a P&L or profit and loss statement unless it looks really bad. So this is why having good bookkeeping, having good record keeping is absolutely vital and important here. Call us if you have any questions regarding this. Again, our number is 520-485-7371. Website is guardiantaxlaw.com, or you can reach out to us through the Smart Money channel or smartmoneyculture.tv, and just click on that opportunity button in the top right corner. And again, don't ignore the states. We see, again, that's when I talk to people all the time, and some people are surprised that the states are worse than the IRS. They absolutely are. And now the Franchise Tax Board normally doesn't do sheriff's warrants, and they haven't really seen them suspend driver's licenses, but there are plenty of other states that do exactly that. And but the Franchise Tax Board is very aggressive when it comes to collecting, to harassing people, and making your life very uncomfortable. Once you get it taken care of, you can use bank accounts again, you can breathe easy, and you can stay protected from what the IRS or Franchise Tax Board might do. So that's kind of a gloss over, a quick rundown of the Franchise Tax Board. Some of the additional little things. If you're going to close out a business, you need to file Form 3715 and fax it to 916-855-5519. And the phone number for that unit is 916-845-7700. So I touched on this. If you have questions, if you have a business that does need to be closed out and you don't know where to start, give us a call. We'll walk you through it and help you make wise decisions moving forward. Tomorrow, we're gonna dive into New York. So their offer program is much better, but they don't have a hardship program. So it's kind of like some of one, less of another. But later on this week, definitely want to dive into that ERC program and really you'll take a deep dive into that as to what that program is, how it can help people, but also can really hurt people. There's a lot of red flags about that program. Again, for the credit that I talked about at the beginning for 2020, 21, get your returns in. That's free money. And there's no scrutiny about that. So everybody that filed pretty much got the credit. And get those returns in, get that free money. But as far as the earned income credit, the employee retention credit, the ERC program, be very wary about that. And the IRS is rolling out voluntary programs to help get some of the money back, but also there's some teeth with it and potential criminal prosecution. So tomorrow in New York, and I'm hoping the next day we'll do ERC. If you have any questions, reach out to us again. And thank you for watching live or on rebroadcast. And again, get your tax returns done. So April 15th is coming up in just over a month. Everybody's busy. Everybody's slammed that's doing tax returns. I do know some excellent CPAs that actually have some space that can get a tax return done quickly and efficiently. So if you need help, give us a call or reach out to a local tax preparer, and in worst case scenario, just do an extension. But make sure you pay anything that could be owed by April 15th to avoid that second largest penalty. Again, Hubert Johnson with Guardian Tax Law, and hope you all have a wonderful day and enjoy the weather if you have good weather. And we're sitting here. So have a great day.